Central Bank has come out with its latest financial stability report, and Ritu Singh is here to take us to the key takeaways. Ritu, what exactly has been highlighted, and how does RBI view how things stand at this point in time, keeping Brexit, keeping the entire global macroeconomic scenario in mind?
Well, very important to point out before I started analyzing this report is that the report was studied and published before Brexit happened, before the United Kingdom voted to remain out of the European Union. So it does not take into account that big factor which is causing a lot of volatility across the financial markets. But what the report does highlight, irrespective of the Brexit outcome, is that the global recovery remains very fragile. That is one of the key risks at this point of time. It also says global growth is weak and uneven. The trade has been witnessing a slowdown, and there are uncertainties in the financial market. Even domestically, it says, although India's financial system remains very stable, the banking sector at this point of time continues to face challenges on account of their low profitability as well as the deteriorating asset quality. Very importantly, in this financial stability report, RBI conducts a stress test study to see where bad loans could be at the end of 1 year in a case of severe to mild stress test scenario. So in a baseline scenario, which is assuming very significant deterioration in macro fundamentals, it assumes that from the current level of 7.6% NPAs, they could rise by as much as 8.5% by March 2017. Under medium stress test scenario, gross NPAs may rise to 8.9% by March 2017. And under a very severe stress test scenario where macro fundamentals are really upside down, there they assume gross NPA ratios may rise to as much as 9.3% levels. But even in the best case scenario, it's important to note in all three conditions, they do see a worsening in asset quality. But there is also a note of optimism where a very important line in this chapter really, which says, stress in the corporate sector has started showing some signs of moderation in FY16. More importantly, it says the risks of lower demand and the weak debt servicing capacity, although it continues, seems to be coming off. If you look at some of the macro indicators that they have given, the share of large borrowers in the total loans has risen to 58%. Their contribution to the GNPAs has also risen to 86.4%. However, if you look at their contribution specifically of the leveraged companies, the share of the very leveraged, highly leveraged companies, which is companies with a debt to equity ratio of equal to or more than 3, their contribution in the total bank debt has come off to 23% to 19% by March 2016 compared to 23% a year ago. Also, there's been some improvement in debt servicing capacity of these weak companies. As expected, iron and steel, of course, contributes maximum to the stress, followed by construction, telecom, and other such sectors. Infrastructure sector's debt has also, contribution in the total bank debt has come off. So banks are turning increasingly risk averse. Their exposure towards very leveraged corporates is coming off. These are some of the key highlights. Other than that, the report is very extensive in its numbers. There's a lot of coverage on the corporate sector stress. There is obviously a review, very importantly, of the banking sector, where they've said the credit growth has come to about 8.8% as of March, deposit growth at 8.1%, both much lower than the previous years. Gross NPAs at 7.6%, net NPAs at 4.6% for the total system, mainly on account of the asset quality review, which the RBI conducted over the past 2 quarters. The public sector banks, as expected, have the highest level of stress at 14.5%, almost double that of the entire sector. The stressed advanced ratios have also increased compared to the previous year. So a lot of small details. Let's not get into that. But we have with us Rupa Rege, Chief Economist at L&T Finance Holdings, Aditi Nayar from ICRA, and Shubhada Rao from Yes Bank joining us to analyze this report. Ms. Rupa Rege, coming to you first. How do you read this report? Would you focus more on the positives in that the corporate leverage and their exposure in the banking system is coming off? Or would you focus more on the fundamentals where risks from the global economy specifically are only rising from here?
Well, I'll give higher weightage to the fact that, the corporate stresses, actually the levels of corporate stresses are stabilizing. And if you look at the fourth quarter or the full financial year FY16 corporate earnings profile, excluding banks, NBFCs and IT companies, actually we see there has been, definite signs of stabilization, and this is certainly positive. Of course, there will be some stresses coming from the global arena, but given the fact that, what immediately matters for financial stability as well as banking sector's health is our own corporate sector's performance, I think I will attach higher weightage to stabilization of corporate balance sheet performance.
So you're more optimistic that the corporate leverage at least is improving. Aditi, what is your take on this? What are the chances you really see that FY17 may actually turn out to be worse than FY16?
So let me talk a little bit about the other side, which is the risks that you just mentioned, particularly the ones coming in from the global side. If we look at the events of the last week or 10 days, we've seen some depreciation of the INR versus the US dollar and some amount of FII outflows, particularly after the surprise outcome of the Brexit vote, which was announced last week. But really, the stress in either the currency market or in the Indian FII outflows is nowhere near the kind of levels that we saw in 2013. And even when we look at the performance of the INR as compared to other emerging markets, it's been very middle of the pack. I mean, many emerging market currencies have seen depreciation in the last week. And I think this is a testament to the fact that Indian macroeconomic fundamentals are fairly strong at this point in time and should be able to persevere through the global events and the volatility that may perhaps continue. I mean, the Brexit vote has happened, but we don't know what kind of events that's going to trigger as far as the other countries in the European Union are concerned. But I certainly think that the Indian macroeconomic fundamentals are fairly strong to be able to really bear the brunt of volatility which may be coming ahead.
Okay, so Aditi is of the view that Indian domestic macro fundamentals are strong enough to weather the global shocks. But Shubhada Rao also joins us, the chief economist at Yes Bank. Shubhada, what are the biggest risks to growth that you see at this point? Are they the domestic risks we face, or are they the global headwinds, especially in the outcome of the Brexit voting very recently, which this report, by the way, has not even factored in?
Yeah, I think, Ritu, the external sector risks were pretty much known unknown. Of course, the Brexit adds to the dimension. Export growth has remained very weak over the last year particularly. So export contraction was being penciled in as far as growth dynamics were concerned. So there was no virtual support for growth coming from exports. So clearly, global risks in terms of currency market channel or trade channel will continue to pose some, risks to growth. But as far as India is concerned, over the last 1 or 2 years, we have depended essentially on the domestic drivers of growth. And the last 2 years in particular, we were seeing an anemic growth or decelerating momentum purely because the rural economy has not been the usual support that we used to see prior to the 2 years. Very clearly, the outlook on agriculture has significantly improved, as the report also cites that, it's not just the overall headline number, but the distribution of rain will be critical. As of now, there is no reason to believe otherwise. So we believe this time around, combining the government's policy efforts along with a support coming from agriculture and therefore the rural economy should limit the downside to the growth. We have actually revised the growth upwards for the current year to 8.1 in terms of GDP, and that is purely because agriculture is expected to bring in at least a 5% outturn in growth. So if we look at the global scenario, external sector will continue to limit our upside to growth.
Yeah.
But in terms of the domestic drivers, I think we are well placed. As Aditi was talking about earlier, I think our macro fundamentals emerge the best. If you look at pre-Brexit and post-Brexit currency movement, we are probably better performers as compared to the whole of 2016. So definitely, fortifying our forex reserves, relatively short-term external debt ratio to total external debt.
Okay.
All these, I think, portend well for India continue to be viewed as a safe destination for global investment.
Okay, Rupa, coming to you, while we're talking about strong domestic macroeconomic fundamentals, why is it, in your view, that the credit growth has not followed? When we're talking about 7-8% growth levels, why is credit growth still languishing in single digits? In the last couple of years that we've seen, it's not really picked up. It's usually the case that credit growth precedes domestic growth. But here, as the case is, even though GDP is seen rising, as the data shows really, credit growth has not followed.
70 to 72% of the banking assets are in the state-owned banking segment, and 40 to 45% of their loan books are directed towards large corporates. So naturally, these banks are in the adjustment mode, and given the rising stresses on corporate balance sheets, so naturally they have become risk averse. And if you look at the most recent earnings performance of state-owned banks, for many mid-sized or small public sector banks, actually their net NPL ratios are higher than their tier 1 capital ratios, which is a very dangerous signal. So naturally banks have become risk averse, and to that extent we have seen that is getting reflected in lackluster credit growth numbers. But having said that, I feel that when you look at the full accommodation of private corporate sector by commercial banking segment, then I have been saying this again and again, that even though last year in FY16 relatively lower amounts were raised in the form of bank credit, corporates, including the MSME and other companies, they raised a large amount of resources through financial markets in the form of CPs, corporate bonds, or some of the large corporates even in the form of ECBs, FCCBs, IPOs, etc. So we cannot say that, and to some of these bonds even banks had subscribed. So we cannot say that the growth was entirely jeopardized because of low credit growth. Actually, the whole system has been adjusting to this lower growth trajectory because of stresses coming from environment, from rural markets, from large corporate segments, etc.
Sure. Just one last word from Aditi and Shubhada both. Do you think the higher GDP numbers to some extent may help resolve this NPA crisis? Can we see a better year now that an AQR has happened? The government has promised capital support. Do you think FY17 may see some improvement in terms of NPAs?
So should I start, or Aditi?
Sure, Shubhada, first you.
Yeah, okay, Ritu, I think definitely the momentum would definitely decelerate. The incremental, that is the movement in NPAs, may stabilize, because as we see faster resolution as far as policy is concerned, we should towards those projects see some, income being recognized, cash flows being generated. So AQR-led, the headline number of NPAs should start decelerating at the close of FY17. We are seeing some amount of these in the data released by CMI also, and we do the PMG analysis, that is the project monitoring group, and there we see that project resolutions are coming on again on a faster traction. This should overall help restrict the incremental build-up in the, asset worsening. So overall, I think we probably have seen or are in the process of seeing the worst scenario underway. And going forward towards the second half, we could see some momentum, towards the improvement in terms of asset quality.
Aditi, just one quick word from you in terms of a yes or no. Do we see FY17 as a better year in terms of the banking sector, or do you think it may be worse?
I think in terms of at least what we've seen for corporate results in Q4 and the trends that we do expect for FY17 in terms of a better monsoon and the pay commission really boosting volume growth for industry, I think that would support earnings, and to some extent that will take the pinch away from the kind of trends that we've seen in the last couple of years in terms of the asset quality deteriorating. But as far as more recognition is concerned, I think that's a different issue. But in terms of what's really happening with corporate balance sheets, perhaps FY17 is going to be a better year than what we
All right.
saw.
Thank you so
in the
much,
recent
all of
past.
you, Shubhada Rao, Aditi Nayar, and Rupa Rege, for joining us. With that, Kritika, back to you.
All right, that was a detailed analysis on the financial stability report. Clearly, a lot of concerns coming ahead, but will 2016 be a worse or a better year than 2015? Only time will tell.